The global monetary reset has already begun, and almost nobody is talking about it the right way. I've spent 50 years studying how economies actually work. Not guessing, not theorizing, but going back through 500 years of history, country by country, crisis by crisis, and finding the patterns that repeat over and over. And I can tell you this specific pattern, the one I'm about to walk you through, only shows up a handful of times in a person's lifetime. It happened in the 1930s. It happened again in the 1970s. And it is happening again right now in plain sight, hiding inside press releases and central bank speeches that are written to sound as boring as possible. That's not an accident either. The most important shifts in money rarely arrive with sirens and headlines. They arrive quietly through legislation nobody reads, through speeches full of careful, reassuring language, through small changes to the plumbing of the financial system that most people never look at. Here is my warning to you. If you don't understand what is happening to money itself right now, you will wake up in a few years and wonder why your savings bought so much less than you thought they would, why your paycheck felt smaller even though the number on it went up, why the assets you didn't own went up so much more than the ones you did. This isn't about panic, and it isn't about politics. It's about seeing the machine clearly. Money is not wealth. Money is simply a claim on wealth, a promise, and right now the world is quietly rewriting the terms of that promise. So by the end of this video, you will see the 3 specific moves being made. You'll understand exactly why they're being made. And most importantly, you'll walk away with a simple, sensible way to think about protecting yourself. Starting today, before I go any further, I want to ask you for something, and I'll be straightforward about it rather than pretend otherwise. What I'm about to walk you through took me decades of study and a good number of expensive mistakes along the way. To fully understand, large institutions pay serious money for this kind of thinking, for analysts who can map out these cycles and tell them where we sit inside them. I'm giving it to you here, for free, in plain language, no jargon required. All I ask in return is simple: hit subscribe right now before you keep watching. Not because I need the number for its own sake, but because there is a lot more of this coming piece by piece, and I don't want you to lose the thread partway through. It genuinely costs you nothing, and it makes sure you don't miss what comes next. All right, deal made. Let's get into the substance of it. Now, to really understand why we've arrived at this point, you have to understand something that almost nobody gets taught properly in school, which is that an economy is a machine. It isn't magic, and it isn't random. It runs on simple cause and effect, repeated millions of times a day, mostly driven by how credit and debt move through time. Here's the simple version. When people, companies, or governments borrow money, they are essentially pulling spending forward from the future into today. You take a loan, you spend it now, and future you has to pay it back later. That feels wonderful in the short run. Businesses expand, markets rise, people feel richer, politicians get reelected, but eventually that borrowed spending has to be repaid. And when a country's total debts get large enough relative to its income, the country runs into a wall. I watched this exact same movie play out again and again in different countries, different centuries, different currencies, and the ending is always shaped by the same narrow set of choices And there are really only four ways to deal with a debt that has grown too large. You can cut government spending sharply, which is painful, unpopular, and politically almost impossible for anyone who wants to keep their job. You can default outright on the debt, which is chaotic, destroys trust in the currency, and tends to trigger a much bigger crisis than the one you started with. You can raise taxes significantly, which slows the economy down and tends to end political careers quickly. Or, and this is the option that governments have chosen again and again throughout history, when they reach this point, you can print money and let inflation quietly shrink the real value of the debt over time. That fourth option is the quiet one. It doesn't look like a crisis from the outside. It looks like ordinary policy delivered with calm language and reassuring press conferences. That is exactly what makes it dangerous, and that is exactly what I believe is happening right now, with the United States sitting on somewhere around $40 trillion of government debt and paying more than $1 trillion a year just in interest, not even touching the principal. When the interest bill alone reaches that scale, a country's real options narrow very fast, and the fourth option, the quiet inflation option, becomes close to inevitable. This isn't a conspiracy theory or a partisan talking point. It is arithmetic. And arithmetic doesn't care which party is in office. And I want to be clear that this isn't just an American story. I've watched variations of this exact same movie play out in Britain in the 1970s, when the country's finances got so strained it had to go hat in hand to the International Monetary Fund. I've watched it in Japan, where decades of enormous government debt were managed largely through very low interest rates and a central bank buying up huge quantities of its own government's bonds. I've watched extreme versions of it in places like Weimar, Germany, and more recently in countries like Argentina and Turkey, where the process ran out of control and turned into a full currency crisis rather than a slow managed decline. The difference between a country that manages this transition carefully and a country that loses control of it entirely usually comes down to one thing: how much the rest of the world still trusts that currency and is still willing to hold it. The United States has an enormous advantage here because the dollar is still the world's primary reserve currency, the one central banks and companies everywhere use to trade and to save. That gives Washington much more room to run this playbook slowly and quietly than most countries would ever have. But more room is not unlimited room. And the three moves I'm about to walk you through are, in my view, exactly how that room is currently being used. So let's walk through the first move in this playbook because it has already happened. And I think most people watched it happen without realizing what they were watching. A new central bank chair stood up in front of the entire world at a major international gathering and promised that inflation would be brought back down to 2%. It was delivered confidently, calmly, the way these things always are. Markets responded well. Financial media wrote it up as reassuring news. But here's the part that actually matters. The part that got buried at almost the exact same moment. That same central bank's own internal forecasts, its own numbers, not outside critics, not skeptics, its own research, were projecting inflation well above 3.5% for the year, and independent measures that try to capture real, everyday inflation, the kind you actually feel at the grocery store, at the pump, on your rent or your mortgage are running noticeably higher than even that official forecast. So you have a public promise of 2% sitting right next to a private admission of something closer to double that figure. I've seen this exact gap before in other countries, in other decades, and it is never accidental. It is a strategy, and it's one of the oldest strategies in economic history. Here is the mechanism that makes it work, and once you see it, you cannot unsee it. If inflation runs consistently hotter than the interest rate a government pays on its debt, then in real terms, after accounting for the shrinking value of money itself, that debt actually becomes cheaper to carry every single year, almost like magic, without anyone ever having to write a check to pay it down. This is precisely the strategy used after the Second World War, when debt as a share of the American economy sat at roughly the same level it sits at today. Governments back then did not pay that debt down through austerity or default. They kept interest rates low, allowed inflation to run a little hot for an extended period, and over the following 20 years, the debt shrank dramatically as a share of the economy, not because a single dollar of principal was repaid in real terms, but because the value of money itself quietly eroded underneath it. The bill for that strategy always lands in the same place, on the people holding cash and low interest, fixed income assets, thinking they are being careful and responsible while their purchasing power is slowly, quietly taxed away. It's one of the oldest tricks in the economic playbook, and it rarely announces itself with a headline. Now, here is the second move, and I think this is the one that is genuinely new, genuinely clever, and one that most people simply have not connected the dots on yet. There is a piece of legislation that requires companies issuing what are called stable coins, digital tokens designed to hold the same value as a dollar, to back every single one of those tokens with real, tangible assets, and very specifically with U.S. government debt. Read that again slowly, because the detail matters enormously. If a company wants to issue a digital dollar under this framework, the law requires that a company to buy government bonds to back it. That single requirement means every dollar that flows into this new digital money system becomes, by law, a guaranteed structural buyer of government debt. This is not a small experiment tucked away in some corner of the financial system anymore. One stablecoin issuer alone already holds well over $100 billion in government debt, enough to rank among the very largest holders of that debt anywhere on the planet, larger than most sovereign nations. And just recently, well over 100 companies spanning payment networks, major banks, and large technology firms announced they are building a joint digital dollar together, an alliance of a size and scale the financial industry has genuinely never seen before. Why would all these very different companies want in on the same project? Because the law bans them from paying you any interest on the digital dollars you hold with them, while it allows them to earn interest themselves on the government debt they purchase using your money. You get a convenient digital token that behaves like cash. They get a steady, low-risk, growing stream of income, and the government gets exactly what it needs most right now: a permanent, structurally growing, legally mandated buyer for its debt, which keeps borrowing costs artificially low even as the total debt pile continues to grow larger year after year. This, I believe, is the part of the reset that most people are completely missing because it isn't arriving through some dramatic crisis moment that makes the evening news. It is arriving quietly through the plumbing of the financial system. One piece of legislation, one corporate partnership, one press release at a time, each of which sounds entirely reasonable in isolation. Step back for a moment and look at the bigger picture here, because this really isn't a story about digital tokens at all. It's a story about a government solving its biggest structural problem. The real danger with a debt as large as this one was, never really the size of the number itself. Numbers that large are hard for anyone to feel intuitively anyway. The real danger has always been what happens if the buyers of that debt start to disappear. Because when demand for a government's bonds drops, interest rates have to rise sharply to attract new buyers, and that rising interest cost can spiral very quickly into a genuine crisis. What this new digital dollar infrastructure effectively does is create an insurance policy against exactly that scenario. Every dollar that flows into digital tokens becomes another guaranteed buyer standing in line for government bonds, which means the more this new technology gets adopted by ordinary people and businesses around the world, the easier it becomes for the government to keep borrowing at low, comfortable rates, which in turn makes it more likely the government continues to borrow even more. It's a self-reinforcing loop. And once you see a loop like that clearly, you start to understand why it was built the way it was, which brings us to the third move. And this is the one that ties the entire picture together into a single coherent story. Every finance minister and every central banker in the world, without exception, says they support a strong currency. It's almost a ritual phrase at this point, something said reflexively, the way a politician says they support small business. Nobody would ever publicly disagree with it, but there is a framework quietly discussed in policy circles that argues the dollar is meaningfully overvalued and that a controlled, managed decline in its value over time, somewhere in the range of 20 to 40%, would help correct persistent trade imbalances and support domestic manufacturing and exports. Nobody is going to stand up at a podium and announce that plan directly, because saying it out loud would spook global markets overnight and undermine confidence in the very currency they're trying to manage. But you don't actually need a formal announcement when the first two moves already get you most of the way there. Gradually and quietly, promise low inflation publicly while privately running it hot, and that is currency devaluation wearing a different name. Build a captive, legally required, structurally growing buyer for government debt, and that keeps interest rates artificially suppressed, even as the currency itself continues to weaken underneath the surface. Put those two mechanisms together and let them run for several years, and you get a slow, steady decline in the real purchasing power of money without ever needing a single dramatic headline to make it happen. The debt, which is denominated entirely in dollars, effectively melts away in real terms, the same way an ice cube left out on a warm kitchen counter slowly disappears. Nobody watching notices it vanishing minute by minute. They simply notice one day, looking back, that a great deal of it is simply gone. So what does history actually teach us to do when we recognize this exact pattern forming in front of us? I have studied dozens of these debt cycles across different countries and different centuries, and the pattern of who wins and who loses through them is remarkably, almost eerily consistent every single time. The losers are almost always the people holding large amounts of cash and fixed income assets, believing sincerely that they are playing it safe, while the real value of that money quietly erodes beneath their feet year after year. The winners are almost always the people holding hard, productive assets, well-run businesses with genuine pricing power, real estate in strong and growing locations, and gold, which has served as a reliable store of value across essentially every currency devaluation in recorded history, in every country, under every political system. So here's a simple framework for thinking about this, not tailored financial advice for your specific situation, but a way of organizing your thinking. First, keep enough cash on hand for genuine safety and flexibility. Something like 3 to 6 months of essential expenses is a reasonable starting point for most people, but understand clearly that anything sitting idle well beyond that amount is quietly losing real value every single year as inflation runs hotter than what your bank account is paying you in interest. Second, look toward assets that tend to hold or grow their value when currencies weaken over time. Quality businesses with real pricing power, the ability to raise prices without losing their customers, sensible, well-located real estate, and a modest, deliberate allocation to gold, which central banks around the entire world have themselves been quietly buying at the fastest pace in decades, which tells you a great deal about what they genuinely believe privately, regardless of what they say publicly at podiums. Third, think carefully about who actually benefits from this new financial infrastructure being built around digital dollars and government debt. It's often the platforms and companies sitting in the middle of that money flow, rather than simply the person holding the token itself at the end of the chain. When you see a structural shift like this taking shape, real money is rarely made by trying to predict the exact date the change fully arrives. It is made by positioning yourself sensibly ahead of it, understanding the mechanics clearly, and then being patient enough to let the pattern play out. I'd also add a fourth idea, one that took me a long time to fully appreciate myself, which is diversification across countries and currencies, not just across asset types. If the dollar specifically is the currency being managed lower, then holding some assets outside the dollar system entirely in other strong currencies or in globally diversified investments gives you a kind of insurance that most people simply don't think about until they need it. I've made this mistake myself earlier in my career, assuming that because I lived and worked in one financial system, that system would always behave the way I expected it to. History has taught me, sometimes painfully, that no single country's currency is immune to this pattern forever. And finally, whatever you do, avoid making dramatic, emotional decisions based on any single video or headline, including this one. The goal here isn't to get you to panic and rearrange your entire financial life overnight. The goal is to get you thinking clearly in principles about a pattern that unfolds over years, so that your decisions are deliberate rather than reactive. I want to leave you with something simple, because I know that everything I've just walked through can feel like a great deal to absorb all at once. You do not need to predict exactly when or exactly how fast any of this plays out. Nobody can reliably do that. Not me, not any institution, not any forecaster on television. What you can do starting today is understand the underlying mechanics clearly enough to make sure you are not standing directly in the path of a very slow, very quiet steamroller. So here is my challenge to you this week. Go and look honestly at your own finances. Ask yourself plainly how much of what you own is sitting in cash or in assets that quietly lose real value when money is being deliberately devalued versus how much is genuinely built to hold up and grow over time. Write that number down somewhere. You'll actually see it. Again, that's step one, and it costs you nothing but a little honesty. If this video helped you see something you hadn't fully seen before, do me a favor and share it with one specific person who genuinely needs to understand it too. Because the people who see these patterns clearly and act early are always in a dramatically stronger position than the people who find out last, after the fact, when it's much harder to do anything about it. And subscribe if you haven't already, because we are going to keep tracking exactly how these three moves continue to develop over the coming months. And I don't want you to miss a single piece of it as it unfolds. Thank you for spending this time with me today. Stay rational, stay patient, think in decades rather than headlines, and I'll see you in the next one.